Hi, this is Randy Finney with Right Side of the Chart, and today is Friday, March 17th, 2023. It is 1:38 p.m. Eastern Time as I'm starting the video. Want to do a quick update on the precious metals. If you recall, and if you didn't see the video the other day, I went through this chart. I looked at the euro, US dollar. I showed you the correlation to both the stock market and gold. It has been a pretty rigid or fairly tight correlation that there's no guarantees it won't disconnect over time. Sometimes these on and off correlations, or these correlations that are mostly on, will disconnect, but I'll show you real quick. Just update. That's not what I wanted. That's Apple. Comparing it to Apple. There's the euro US dollar. If I go back in here, edit chart properties, compare it to the stock market instead of Apple, you can see right there, this is what I'm talking about. Just to kind of recap, remember the bear market started, depending on when you're looking at NASDAQ or all the other indexes, right here in the beginning of early January 2020. There's the S&P 500 in green. That's when it peaked, and you can see a unmistakable, very strong positive correlation between the euro. Here I'm using the euro US dollar pair. It's the same thing. It's the euro against the dollar. The euro is the dollar largest component. All right, so that's it. You can see all the pivots. Look at where the turns came in. Remember, you don't need the lines. They're not going to overlap because they're not priced in the same units. You know, the stock market or SPY we're looking at here, the euro currencies move less in percentage terms than stocks. So you look at the turns. Anyway, you can see it's been a very strong correlation. So the other day I told you I called it, I don't want to call it a hard pivot or soft pivot. Right now it's more of a soft pivot because we're still above trend. So just to kind of recap another thing, forever and a day I was favoring a pullback to this uptrend line in the euro, which we got. We were rallying. Also, we had that big divergent low not too long ago that was very bullish for the euro, dollar going down. So whether it's the chicken or the egg thing, which came first, if this correlation, if it's due to the stock market, then the currencies are impacted, or it's the currencies, or they just move together, recognize that is a relationship. And therefore, where I'm going is if the euro, if we go and break this trend line, which was the pullback target, and we break that support, there's a good chance, especially when I look at the longer term charts here, that we could take another big leg down, and that would mean the euro falling and taking gold and silver with it, and the dollar rallying. And as I said in that video the other day, because of what I just showed you, the very strong correlation between the stock market, if we're going to get another leg down in the bear market, at least if we're going to get it soon, it could come 6 months, a year from now, depending on what happens. But if we're going to get it soon, as I suspect we might, then you're most likely going to see this happen. The euro break that uptrend line here. This is a weekly chart, and head on down, and maybe ultimately go in to put a divergent low. That would mean a rally in the dollar. And that tends to happen, because first of all, there's usually the dollar, as much as other countries, especially China, Russia, a lot of our foes at this point in time, trying to get away from the dollar being the world's reserve currency. It still is. A lot of countries still own and need dollars, especially in times of financial distress. So that's one reason. So the dollar rallies and when the stock market falls and the euro drops. And then again, I've showed you before many times a very, very strong correlation between the gold and silver and the dollar. Okay, so that's kind of everything I covered the other day. Now look, we haven't broken that support level. This is a 60-minute chart here. Let me show you the E7, the chart I showed you the other day, and I want to clarify, or I did try to set straight. Somebody said in one of the comment sections today, hey, why, you shorted gold or silver, that was a bad trade. No, you can go back. I didn't think I said that, and I referenced, my post is on there. Yesterday, or the day before, we were right here at intersecting uptrend line and price support right here. This is E7 Euro futures. And what I said, I had expected a bounce, and a small one, so I had a little arrow drawn, and gained that bounce, went long the euro. I even stopped the video to do it, and then I ended up going, with also buying gold and silver because they're going to go up and down with the euro. But clearly stated yesterday, that post again in the morning, before the ECB rate announcement that I took profits. That was it, but I didn't short. I got out the day before, I think it was, in GDX, only because of my concerns there. So that when I exited. So there's a big difference of selling a long position and then reversing. I do often reverse when I, the way I kind of time the markets. A lot of times when I close a short, I also go long that same security. But I just want to be very clear and double checked. And no, I didn't. I even looked at my trades, second guessing myself. But no, but as of now, right before the video, I did just short gold. And I'll show you why. So again, right now, big support. You can see I've sensed that was the support line I had there at 105, about 105.88 on the euro. It's intersecting support. So you have both uptrend line support on, this is, the raw thing, the euro futures, E7. And there's that price support. So if we break that, a solid break's probably going to take us all the way down, at least to that level. But if that happens, is why I always trade multiple time frames. This is just a little seeming, I called it a 60 minutes, it's actually a 120-minute chart. But then that has a longer term or more significant repercussions on this, that daily and weekly charts. We go back to where we're at right here, the euro, US dollar. See, we have the potential to break this uptrend line. I'm going to tweak it just a little bit better to fit this low, all these reaction lows right there. So we're on it right now. Honestly, I don't know which way we go. Nobody does, obviously, but we'll have a better idea come Wednesday. Remember, what makes one country's currency go up or down? Currencies are priced relative. There's no fixed pricing. They are priced relative. So the U.S. dollar, we look at the U.S. dollar index, is a basket of currencies. So the dollar or the euro or the Swiss franc or the yen, they move up and down based on what they're doing against other currencies. And usually what drives them is that country's interest rate. So if the Federal Reserve raises rates more aggressively or speaks a more hawkish talk, and in the community, the investment community thinks the dollar is going to go, our U.S. interest rates are going to go up more than those over in Euroland, in the Eurozone, then the dollar tends to rally and vice versa. So the other day we had a 50 basis point hike from the ECB. It was not a shock because I had heard rumblings of that. Maybe surprised some that they did it, but I'll tell you, it's been in my opinion, very muted, really no rally at all. I mean, I told you, it's got to be a gambler to go into, hold a currency like that into a central bank meeting that could have gone either way. I mean, if they hadn't done the 50 basis points, if they only did a quarter point hike or even especially nothing, I'm sure the euro would have plunged right down through there. They did 50, and I'm surprised it didn't rocket up anymore. And that, to me, shows a little bit of kind of maybe a bit of a tell. Now, again, it was at and still is great support. You got the 50, and it did go up just a hair. This is where we were right before the meeting. I told you, again, just sidestepped that. But it wanted to wait for the dust to settle. And I'm still going to wait for the dust to settle now before doing a whole lot, although there's a tactical trade. I always speak in different time frames. I am an active trader. I day trade a lot. I short-term swing trade. That means a day or two in and out, sometimes 3. And then I long-term swing and trend and position trade as well. I have different accounts, IRAs, active trading account, everything in between. And so I try to let you know what time frame I'm speaking about. So I'm going to show you some things here. Now, again, we have the FOMC meeting coming on Wednesday. Nobody knows for sure what they're going to do. I haven't looked at today at the odds. I think the odds are pretty much baking in a quarter point. That's what I think we'll get. And your guess is as good as mine if they do nothing or if they do 50. 50, I'm sure the market would friggin' get roiled. I don't think they're going to do 50, but whether they do 25 or 0, let's just wait and see. But we'll probably see some volatility between there and that now and then. I've already given you my thoughts. It's just a guess based on my read on the charts and intuition and experience of trade. I think we'll see the equities sell off between now and then. Nervous profit taking and or maybe trying to send the Fed a message. You better not, meaning that we want nothing or at most 25. We'll see. Who knows? Maybe I'm wrong. I told you that before. Trade what you want. And the safe bet, if you are risk adverse, is just hold off, wait until the Fed's out of the way. It's going to be a big meeting for sure. And it's not just what they do, but what they say. But again, the Fed, their biggest weapon now and in recent years really is jawboning. They know they can't go up much more. He was, Powell's in a bad position. He tried to talk the tough talk. He's a dove by nature and been trying to talk the tough talk lately. And even, he followed through with some hikes, but obviously he's not going to be able to do the 50 like he was indicating just a week or so ago. All right. So technicals. All right, there it is. So watch that. That break of that is going to be bearish for gold and silver. A break of this would come if the Fed is either in action or rhetoric more hawkish than expected. What does that mean? Well, 50 basis point cut would certainly be more hawkish than the market's expecting. Or if Powell still beats his chest and tries to, talk the tough talk about, continuing to stay hawkish and fighting inflation as being the biggest problem he sees more than the financial system. So now if this goes up, euro goes up, gold and silver will likely most likely continue to rally, and remember that would also indicate which way the market's going to go. But let me show you something and why I just took a little short on gold here. This is the 60-minute chart of GC gold futures. There's that previous reaction high. We had been bullish up that most of that uptrend, got out, shorted most of this downtrend here. We came in divergent low, bullish falling wedge, beautiful time to get long, double bottom breakout, back tested those lows, off to the races, and we have come full circle here. Just as that divergent low here, and then really pretty much the low was actually in just before that. That was a slightly higher low. Technically that was the bottom and that was the divergent low, just like that was a divergent high, and now we have a divergent high at resistance to boot. Resistance being the previous reaction high. To say that gold is getting a little stretched here would be an understatement. We're at 80 on the RSI. I'm just put a line right there. Typically, you don't get that much more oversold with at least a pullback, and usually those extreme levels, after they've been hit several times, or can mark the end of a trend, or at least again a correction. You get that 80 level, you get a little pullback. So Fed's next week. Again, it's just a shot you can take or not take. Let me show you silver. Silver, you can see we're diverging, and silver has potentially a little more upside there, or it does have. Well, we're at that previous reaction high right here. So that in itself, there's divergence because the prices are making an equal high with the indicators making lower highs. That is negative divergence. And should silver push up just a little bit higher, so in other words, I see minimal upside, big resistance there, pretty good resistance around 2270, 2275 or so. Okay, so I think we either reverse here or go up there. Again, it's a shot. And then let me show you a couple other charts. I know not everybody trades futures. I like to for various reasons, including the fact that GC and silver are trading around the clock, and I don't have to worry if there's a huge move overnight at 3 in the morning. I'm sleeping and some global event happens, and gold and silver shoot up and down one way or the other. I don't have to wake up to a huge gap down that's going to bypass my stop loss order on GLD or SLV, which is what happens. But there's a big old fat divergent high. It's not confirmed. It's what I call unconfirmed divergence, because PPO and RSI are momentum indicators, and that momentum is clearly pointing up right now. The indicators are. But we're also at resistance. I've had that line there, 183.54, since 2021. Haven't even tweaked it since 2021. It's a pretty big level. We've had a few spikes through there. And that's it. So you have negative divergence at resistance and overbought. You can see even on the daily chart. I just showed you the 60-minute chart a minute ago, how we were overbought there. On the daily here, we're at 72.70 on the RSI. Last time we were that overbought was right here through this period. And then here, right there, and then here. And that was coming off, this was coming off an explosive divergent low. by the way, those first two overbought readings. Now this run's getting a little extended there. So that's it. And look, here's the thing about shorting. I don't short overbought just for the sake of shorting overbought, because overbought, as I often say, you were right there, then you overbought a little bit more there. You had a little pullback, but nothing, and then you were more overbought there. You would have got murdered if you shorted just because gold was overbought there. So it's the divergences. I like to see, prefer to see overbought with divergences and at resistance. Those three things coupled in. And there's a lot of momentum behind it now. They may carry it over. You know, you get a momentum fueled overshoot, I call it. But I just wanted to share my thoughts. And again, probably going to see some volatility in interest rates and the equity markets between now and Wednesday. Often markets go into a holding pattern before a big market moving FOMC meeting. I told you I suspect this time around it's going to be more of a downward drift, I suspect, than just holding where we're at right now. Again, I would think profit taken. Maybe I'm wrong. So that's that. GDX, yeah, that one I sold, I think was day before yesterday. Although I did find a little nugget. I have, multiple, family accounts, IRAs, and a small inherited IRA my wife has. I didn't realize I still had some GDX in that from this last trade. But it was not, believe me, a small position, hardly anything. But I just sold that today because we're coming up on. Well, I sold it mainly because where gold and silver are. But then you can see on GDX too. I have a resistance. It was T2 back here. Remember, GDX was a long trade. This T4 is kind of in question now because, like I said, I've done more of a. We need the evidence. I showed you that my scenarios are unlikely to work out together again, meaning the stock market down. I'm talking the next major leg down, and then gold. I've been very bullish on gold for a while, calling for new highs. It's unlikely to see both, but not impossible. And that's why I've just kind of moved more to that soft pivot, is what I'm calling it now. And again, I'll wait for the evidence. The euro hasn't broken down. In fact, on the contrary, it's at support. TA 101, Trading 101 says you buy pullbacks to support. You don't short them, or you wait to the support level breaks if you were planning on shorting. So right now, like again, this is what I just told you on gold and just showed you. That's called a tactical trade or a short-term trade. Just came a little pullback. We're getting very extended today. And then GDX, again, this was resistance here, and it still is resistance now. So there's probably limited upside to a pullback in GDX. We are coming off a divergent low, but what we could do, if we take another leg down in the euro and gold and the metals, it may come down and put in an even larger divergent low after a while. And if that's the case, then I'll look to re-enter these as swing or trend positions. But if that's clear, that's what I'm trying to say. I closed at a swing or a trend position the other day that initially I'd planned to hold, up here till T4. At least T4 was hit. I'm sorry, that's right there, about $36. And maybe that gets hit. But again, I didn't short GDX the other day, nor did I say I did. I just exited a long position. There's a big difference there between the two. And there's a gap right here. I'll put another line. You see on GDX right there, gap. And that's it. So time, at the very least, just like I started closing those positions in front of the ECB tomorrow, to, again, maybe book profits on some things and that are profitable, especially if they're going to be subject to volatility due to the upcoming Fed meeting, Fed rate decision, as well as even those that you might be underwater on. Losses can always get worse. So like I said, everybody's different. If you're risk adverse, it's just not a good time to be engaged in the market. The VIX is still elevated, and that's something else I forgot to cover in the other video. I was going to send it out to you last night in last night's video, and I missed it. Is the the VIX? I pointed out the breakout here. Pointed out before we even broke out the divergence. Then the other day, right here, gave you an objective short entry, and then this is what I meant to cover in the video. We were right there yesterday around the close. Right back to that same level. Had it here. It's not changed. 2360, about 2360. It's really good. It's the first resistance level. All these reaction highs found the breakout, and so far that's what we pulled back to. We keep getting these little divergent highs, and pull back, and that's where you highlighted. And I was very clear, almost emphatic, the other day that even though we had popped that 2739 briefly, that was what I said, not an objective time to add to the VIX. You don't add to the VIX in what I call no man's land. Even though I think it's still going higher, you add on pullbacks to support, not when it's stretched, because as I said then the other day, the VIX can fall like a hot knife through butter. And it did when you get a little rally, and it can explode back to the upside. So the VIX, bottom line is, the VIX is still elevated, meaning higher than it's been in recent weeks. And it's still very much, the breakout is still very much intact. We have a breakout, a back test, and so far, and yesterday's low and this morning where we were there again. It's a higher low. It's a pullback to support, and we're starting to move up. So if my sell off into the FOMC meeting pans out, it won't be a straight shot, but we'll probably move up again. And then if my whole next week we get hammered in the market thing pans out, then yeah, you'll see the VIX explode. Otherwise, you'll see the VIX melt down if I'm wrong. So trade the VIX accordingly. I don't throw that out there often as a trade idea. I told you can use VIX futures, options on VIX futures, which would be, if you're bullish, calls on the VIX. And then you can see it here. There's that breakout, back test, and then that 2254 level I've had there forever and a day too. That's a support level I've had. Remember, we had that initial consolidation after the breakout and the back test, and then we broke out and we're still holding above that. And that's sometimes what the VIX does. It has these little periods. Sometimes it just spikes up, but then sometimes you do have, like right here, you had a breakout, little consolidation back and forth for a few days above the downtrend line. Then VIX melted down, the market rallied. Bulls were probably cheering like they were the other day, and then boom, it exploded. So I don't know. I told you my thoughts. It's a long shot, but I still think that's it's the odds are against it only because the market's rallying right now, and there's quite a bit above support. And there is certainly a bullish case to be made, both fundamentally with the bailouts of the banks lately and some technical levels. But like I said, it's as much as anything else based on the longer term charts, breadth deterioration, other things I showed you there that I think this could still play out. And remember, that's if we do get another leg down that undercuts the lows, if things happen really fast next week, that was COVID right there. And the VIX, this is big resistance around 37.61 since COVID. Every little area, you had a brief spike one day, right back down below. Second test, another rejection, near rejection. And since then, we've started to work a little downtrend line as well. So, boom, break above the downtrend line, and then a break above 37.61 would almost certainly mean the stock market's going to new lows. I don't want to get ahead of myself because we're not even there yet. And believe me, we've got a lot of work to do. And this thing could just melt off and come back down. And if the market's going much higher, it'll probably take out this trend line and then work. You got support levels here. In recent years, ever since COVID, really this was the bottom of the range of the VIX right here, with a sub bottom or sub range right there. And then before COVID, we were in an era of super low volatility, and then before that, up back into that fourth quarter, there was that. Remember, I keep always talk about the Q4 meltdown or correction. We were in an unseen. The VIX had never ever been such low levels. So you can see this is kind of the financial markets in a nutshell. The VIX has been these bottom ranges have been stair-stepping higher really since 2018. As as the massive credit bubble and everything bubble, of uber excessively low interest rates for an excessive period of time have kind of caused that. And then on that note, likewise, just like we've been stair-stepping higher, the spikes, Q418, COVID, and I will bet you before this bear market is said and done, we'll finally get at least the first good, solid, tradable bottom that I was talking about today when I showed you that all the breadth indicators that we haven't yet hit those levels that have marked the end of previous bear markets. Before all is said and done, we'll probably put in a new higher high in the VIX. So what does that mean? Again, whether it happens in the coming days, weeks, months, or whether it's later this year or even next year, that would mean as much as 350% or so on the VIX from where we're at right now. Oh, but guys and gals, if you are new to investing or even not new to investing, the VIX is not a buy and hold instrument. You will, I give very few guarantees, very little. The only guarantee I ever give you is I'm going to be wrong. But I can all but guarantee you, if you buy a VIX tracking ETN, such as VXX, UVXI, any of them, you will lose money, especially if you lose money if you hold that over time. It's a guarantee. VIX is a hit and run. Your timing needs to be precise when trading the VIX. This is VXX. So if you bought it back in even when COVID hit. Okay, so look, let me do this way for you again. Here's the VIX. This is the VIX spot index, and so there's COVID right there. There's the COVID lows right there. So let's just say you bought it right before COVID hit. You had perfect timing. You nailed it, and you wanted to just tuck it away because you figured we're going to be in a long-term bear market, whatever reason. And so the VIX is a lot higher. In fact, I'll tell you exactly how much higher since COVID. I'm going to measure from here. Today, the VIX is, we'll go to today's price right here. Or let's just go to the recent high. It's going to be easier to track on the other chart. Oh, no, I can track today's price. All right, so we are, the pop-up box says 109, 110% above where we were from there. So let's say you bought VXX, and you were lucky or smart enough to buy it right there at the lows. Today, go to today's price, you would have lost 75%, nearly all your money. Instead of having doubled your money, you would have lost. And that's just the way these things work. This thing rolls these futures. It is not the futures. It is just an ETN, a banknote. I've seen these VIX ETNs blow up a few years back. A couple of them went bye-bye. The VIX exploded. On paper, you should have made a ton of money, but instead you lost almost everything because ETNs are just an IOU from a bank or whoever issues them, Barclays or whatever, whoever the issuer is. It's not an ETF. And so there's risk in any ETN, number one, but then the VIX is so, all right, hopefully I've made that point, and I threw the VXX as you can trade it. If you trade it, look, the move's been strong, and these are potential targets, but I would align those targets with those on the VIX. So if I'm right next week, we're going to pop. We're going to sell off hard and pop and then get paid. And if not, and you have too much money in the VIX or any of these instruments, you're going to lose a lot of money. So Vegas money, guys. That's what I tend to do with the VIX. It's all a function of my degree of confidence. More confidence I have in a trade, the more I might put in there. But at the end of the day, you don't put half or all your portfolio in the VIX, even if it's the futures or these ETNs. Okay, let's wrap it up here. Really started the video out to kind of give you those updates on gold, silver, show you where we're at. Really, once again, trying to impress the relationship between the euro and the dollar, and that's all going to change come next week, depending on what the Fed does. The currency markets are going to go one way or the other, and then therefore gold, silver, and the stock market, again, as I showed you those correlations there. So that's it. Well, I don't know if this will be the last video of the day or not. I have a company coming in town this weekend. They'll be here in a couple hours, so maybe I'll wrap up here. If I see anything else, I'll get it out to you. Otherwise, have a great weekend. This has been Randy Finney with Right Side of the Chart.